Hey miners, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome back Jeff LaBerge. He's the head of capital markets and strategic initiatives at Bitdeer Technologies. We're going to be covering their earnings, but more importantly, their technology roadmap, their outlook, and their strategy moving forward in today's presentation. Now, before we get into all that, you guys know the deal here. Please take a second, hit the like button. It's a big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below what you think of today's discussion, if you have any additional questions for the team at Bitdeer, and if you're currently holding shares. Now, with that being said, let's get into today's interview. Okay, guys, so that's right. We've got Jeff LaBerge here, head of capital markets and strategic initiatives for Bitdeer. Now, there's been a lot going on at this organization. We actually talked to Bitdeer down in Nashville. They obviously have the seal miner tape outs coming. We've had earnings. Jeff, so much to discuss today. Thanks so much for being here. We really appreciate your time.
Oh man, always good to be here, guys. Yeah, a little bit going on right now, right?
Yeah, I can say you're not alone in that statement. Every one of the C-suite that we talk to right now says they're just absolutely back-to-back meetings all day long, which obviously is great for shareholders, means a lot's going on. So let's get into that in today's discussion.
Sure.
First and foremost, Jeff, you came out with earnings. All of your business units are creating a gross margin. Can you talk about some of the highlights from these recently released numbers?
Yeah, sure. So yeah, Q2 total revenue was just under $100 million, I think 99.2. We mined 628 Bitcoins during the quarter. Our adjusted EBITDA was 25 million still. So we had a bit of an uptick in our R&D expenses as well, just on our normal run rate. So of that, about 6 million was R&D. So overall, fairly profitable quarter from an adjusted EBITDA standpoint. Still generating pretty good margins on our cloud hash rate as well as our hosting business, but still in that high 20s, low 30s gross margin range. So overall, it was a tough quarter for the miners, so we were fairly happy with it.
I was going to say Q2 was widely forecasted and estimated to be a pretty difficult quarter across the board. And as Anthony's coined it, this was a pretty good update for a bad quarter in the sector. So we're happy to see it. A lot of developments there. The one that kind of caught my eye, I wanted a little bit more attention on, Jeff. You noticed, or you guys basically noted that a big portion of your net loss was due to non-cash expense related to the tether warrants. I just was wondering if you could explain that a little bit more.
Yeah, so it really has to do with fair value accounting for warrants and derivatives on the balance sheet. So, when you issue warrants, there's accounting treatment for them, and you theoretically value that as a liability on your books, even though it would convert to stock. But should those warrants become more in the money, that liability will increase. So the liability goes up, and there's an offsetting expense or non-cash hit to the P&L for that. So tether warrants were struck at $10 per share at the time when the stock was trading at in the fives. There was obviously a nice run up in the stock toward the end of the quarter. So that's where we had the derivative liability recognized there. So non-cash, and ultimately if those convert to equity, that it all washes out. But again, it's a non-cash expense, and I think it was about just under $15 million.
Jeff, you just highlighted about one of the reasons for the additional cost there was R&D. Can you provide a little bit of more of an understanding? Because I mean, we've talked before about the R&D at Bitdeer. I mean, you've got more people employed in R&D than most of the miners have got employed in Bitcoin mining. So can you just give us a bit more of a flavor on that, please?
Yeah, so the way I look at our R&D right now is we've got a pretty stable run rate of about, let's say, $5 to $6 million per quarter. Now that's up a bit since maybe 2023, since we've really started ramping up on the seal miners. We've had to hire some new people. We've hired some very high quality engineers. Paris's team has been hiring. So that number crept up a bit. So call that kind of our base runway from a cash standpoint. And then really the only other significant R&D costs for the CO miners are the tape outs. So every time we tape out a new CO miner design, the tape out is basically the transition period from the design phase to sort of the manufacturing phase. We send that design over to TSMC. They build us a mask for that design. And what the mask is, I basically call it like the printing press for that particular chip design. It's what they use just to print all the chips. And if that comes back the way you want it, then that mask can be used, almost indefinitely. You can print hundreds of thousands of wafers with those masks. So it's a one-time expense, and it generally is about $15 million. So we've done one for A1. We've also already paid for one for A2. It actually, I think, showed up in our prepaids for the Q2 timeframe. So the tape out for A3 and A4 will likely be in 2025. So I think that's a pretty good way to kind of take a look, forecast what our R&D expenditures would be.
Awesome. We'll probably come back onto the seal mine, and every time I hear that, I hope to you've actually copyrighted that name, because every time I hear seal mine, I'm looking for cover light as an ex-military with 25 years service.
Yep, exactly.
So talking a bit more about capital and the levers that are available to Bitdeer in raising capital. Can you sort of explain in 2024 which levers you've actually pulled already, and also we can then start talking about what you announced this week?
Yeah, sure. So obviously we did the financing with Tether, $100 million, just a straight common stock transaction. Then there was another 5 million warrants attached to that. Interesting though, like I was saying, those warrants were struck at a strike price of $10 with a maturity or an expiration of only 1 year. So in other words, if they trade above $10 anytime this year, they can be exercised. If not, they expire. So we thought those were pretty solid terms from a global player in our industry. So a good player that we want to have in our cap table. And then we do have the ATM in place. We've used that a little cautiously, pretty sparingly since at least in the second quarter. I believe we only raised about $5 million or $6 million or 1 million or so shares off of that. So it's obviously a lever we can use, but we continue to believe that our stock is relatively undervalued at this point, and some might argue very undervalued at this point compared to a lot of our peers. So, we've used the ATM. We will use that as a tool, but we are a bit more cautious with it. But obviously, it's a great tool to have, and it's a great tool to take advantage of at times of high volatility and upward momentum.
Yeah, that's really good to know. So this week you made a big announcement in terms of the convertible note. Can you sort of briefly tell us about the length of the period of the note, the interest rates associated, and probably more importantly, what does this mean to retail investors? Because at some point those notes get converted. What is the impact to retail investors at that point in time? And just explain sort of like the methodology of how you go through this process to get to where you've got to this week.
Yeah, so I guess just explain the mechanics of the convertible bond. So it is a 5-year bond that is with an 8.5% coupon, and it's convertible at a 35% premium to yesterday's closing price. So I believe that's going to be somewhere in the 856 range. So it's convertible after 6 months. So anytime after 6 months, the investors could, if the stock price is above that, they could convert it into stock. Coupons are paid twice a year, just like any type of regular way convertible are. So that's sort of the basic construct of it. And so Yeah, I mean, going into just the sort of the mechanics of it and the types of investors, it was an institutional offering. So we did a full confidential and then a marketing period over the first 2 days of the week, or Monday, Tuesday, Wednesday, and then where we were pitching it to investors that are interested in that specific asset class, and then you do what's called a public flip on. Which happened yesterday, where it goes into the market, and then additional investors then have the opportunity to come in on it. So that's what happened yesterday, and the deal priced and is, I believe it's actually trading today.
It was open to ordinary retail investors. Some of these are sometimes locked into like institutions or private buyers, but this was both, I take it.
Yeah, so I guess retail investors theoretically could invest in it. I mean, convertibles, individual convertibles are typically for institutional investors. I mean, a retail investor could do it. I would understand the majority of that would be done through funds or ETFs. Convertibles can be somewhat less liquid than other bonds or stocks. They just don't trade as much. So normally the way to get exposure to that is through a mutual fund, a 40 Act mutual fund, or an ETF. But so I believe, I haven't seen the full book, but to my knowledge, it's all institutional.
So it sounds like you've not used a great deal of your ATM. You've potentially got maybe some more money coming in if the stock price gets above $10. Those warrants are activated in the next 12 months. You've got this convertible note now. You've also got the potential to increase the convertible note by another, I'm going to say $22.5 million.
Yes.
Should you have a period to activate that. In terms of what you require for the next 18 months in terms of infrastructure, machines, how far does what you've got at the moment now in your plan get you to that position?
Yeah, I mean, obviously, this is a capex intensive business, and it's going to require quite a bit of capital to execute on our pretty ambitious growth strategy. So, but this takes us a fair way there. So, as of the end of Q2, we had 206 or 204 million of cash and another 26 of cryptocurrency on the balance sheet. So, we felt pretty comfortable with our liquidity position. This was somewhat of an opportunistic capital raise here. But we really wanted to have some additional working capital just to, one, provide for just to complete the build out of our pipeline sites right now. We've got our Norway site that's close to completion. I think the first 40 megawatts could be available in Q4, and then the rest, the other 135 will come online sometime in the first half of 25. We've got our Maslin, Ohio site that's under construction, and that's being built out right now. Bhutan we've broken ground on, and we'll have some commitments there. So we wanted to have ample working capital so we could accelerate those, but also for the launch of our seal miner. So A2 has been taped out, as I mentioned, and we are expecting the test chips back at sort of around the end of September, early October. And if they come back the way we expect them to, and the way we've modeled them, those could start going into mass production in Q4, and we could be delivering them shortly after that. So wanted to have enough working capital to be able to make a meaningful chip order. As we go on, the ASIC business is typically financed, as we've known, through customer down payments. So you'll get down payments from customers, and so that kind of helps with the capex spend there. So, but again, for these first rounds, we want to make sure we have enough capital to make a good run and a good order of chips, and really to be able to get those out there.
Just want to pick up on one thing you said at the start of that conversation when we talked about the balance sheet. You mentioned cryptocurrency on the balance sheet. Now, we're always led to believe that Bitdeer was selling their production on a regular basis.
Yeah.
Is it a case of you started to hodl, or is it a case of you hadn't sold at that particular point when the June 30th timeline occurred?
Yeah. So our policy still is to sell, shortly after mining, as soon as practicable after mining it. So there is a combination of two things. Some, were kind of cutoff issues where we'd mined it and maybe we hadn't sold it quite yet. So there's some Bitcoin on there. The rest is actually some Ethereum that we actually acquired through a previous past deal several years ago that was actually just paid out to us, I think maybe earlier this year. So a lot of it is that, and we had just had to hold on to it.
Gotcha. Thanks for the clarity there. Are you doing any staking on the Ethereum?
That's a good question. I should actually find that out.
Call up Sam Tabar and he can give you a quick lesson on the.
You know what? I thought you were going to say that, so maybe I'll do that right after this. So.
Hey,
right now.
I want to get into the seal miner, but I had one follow-up question. I just asked Adam this as well. In terms of institutional investors, you said they were the main focal point for this convertible. How are you seeing institutional interest now compared to retail? Do you know the percentage approximately of shares held by institutions?
Yeah, so that's a really good question and a good point I want to bring up. So another reason, really rationale for doing the convertible is for that reason alone. There is that we are looking to become more institutionally held and get out to more institutional investors. And again, a convertible is typically an institutional type of offering, and so that was one of the other kind of intangible benefits of it. Is it just broadened our institutional ownership. So there's different types of investors that invest in converts, and maybe want to go into this or not, but you have fundamental investors who are basically just equity-like investors that like the fundamental story and will invest in it. Given that the convert has some different upside and downside protections as well. And then you've got your arbitrage investors that are really just playing the volatility of it and the ability to arbitrage the coupon rate by shorting out and just offsetting the long exposure of the convertible. But again, mostly institutional investors there. And I'm actually still just looking and gathering all the new F-13 filings, but we have had a significant increase in institutional ownership. I don't have a number yet because I'm still kind of going through the new filings there, but a lot of new investors have converted over. Ones that we started talking with sort of late in the quarter. There's other ones that I know of that didn't show up that likely invested after 6/31. So I think our next 9/30 run will show quite a bit of institutional investment in our stock.
What size is Tether's position in the company at the moment?
Last F335 was 20 million. So they picked up 18 million from the offering, and it looks like they bought another 2 million in the open market.
Gotcha. Yeah, thanks for the insight there. It's so great from a retail perspective to hear that we were able to beat Wall Street and the institutions to these stories.
I know, right?
It's also great to see them coming in with the real heavy guns and the big money too, right? So that's awesome.
Yeah.
Oh, go ahead.
No, I was going to say, and I think it really works to our advantage because, frankly, we've always been a more complicated business model. We don't quite fit into the pure play self miner box, so it's always hard to kind of to comp us to a lot of our peers. And I think that had always been kind of one of the disconnects in our stock price, frankly, was that we weren't just that pure play miner that you can compare to some of the riots, the marathons on an apples to apples basis. And I think for that reason, I think our stock, it may have been overlooked. And I think that led to some of what we believe is undervaluation of it, because if you look at how we're valued right now, I mean, now it's even more so, but on an enterprise to exahash basis, it would appear we're being valued really just based on our proprietary hash rate, which, as you guys know, is not the lion's share. It's less than half of our current revenue right now. Obviously, we're going to grow that, but and it really ignores the hosting business that's in place and some of the other upsides verticals that we have.
Hey, that's a great segue. You must have read the questions here. So we're going to talk
I
about
mean,
some of those
what are you
key
talking about?
differentiators. Uh,
Yeah.
being the seal miner, the vertical integration is a key point of differentiation. And then obviously your energy pipeline, which you guys have a
Yep.
tremendous amount of megawatts coming down the pipe. So we'll get into these right now, Jeff. So first and foremost, the seal miner. This has really been a success story from day one, but we wanted to hear in today's episode a little bit more about the relationship with TSMC, how this works. We actually just talked to Adam Sullivan. They've struck a partnership with Block, but
Yep.
Block is actually still designing the chips, and then they're working with them at that point.
Right.
You guys with your R&D team, you have a lot of knowledge and skill set in terms of chip design development yourself. So can you talk to us a little bit about that relationship with TSMC? How do the costs compare to some of the other options available in the market right now? Just a little bit more color on that.
Yeah, sure. So we obviously have a very good relationship with TSMC. I mean, Jihan has known TSMC for years through his prior dealings at Bitmain. Harris Bassett, our chief strategy officer, has good relationships at TSMC, and that's really part of it. Just knowing them and having that relationship, but it's really about getting an allocation, from them. So we feel confident that we can get an allocation from them for our chips. Like I said, we're taping out right now, so it's been a good relationship.
In terms of the what you're producing now compared to what you can buy off the shelf, and taking into account, obviously, you've incurred development costs to get to that stage. When do you sort of, is there sort of like a number in mind where you get to a position where you've paid back the investment and you're now then into sort of like, effectively saving, I wouldn't say profit, but saving yourself considerable on what the market price of other competitive machines are at the moment?
Yeah. So we're going to put out some more at some point, detailed information about, be more transparent about the cost. We have not done that yet, so I can't comment specifically on numbers there, but I think it's fair to say that we will be able to produce miners at a discount, at cost for ourselves, at a price lower than what we're seeing in the market right now. So that'll be one of the main benefits to us, is that obviously we can grow using our own miners and have full control over the supply chain, as well as a significant cost advantage. But we think the real opportunity long term is selling the miners to third parties. If you look at the last bull market, obviously Bitmain was likely the biggest beneficiary of that, for being able to sell the rigs. And that really has to do with just the way miners have been priced historically. They've typically been ROI priced for let's say a 15 to 24-month payback, depending on when the time period was, based on where Bitcoin was, and also based on demand and supply and demand. So it'd been fairly lucrative. Obviously some of those dynamics have changed, but we still think they will hold up moving forward. I think as supply kind of dwindles a bit, should we get into that bull market next year. But I think it was Bernstein that actually just came out with a report, valuing the total addressable market for ASICs over the next 5 years at right around $20 billion, which was similar to some calculations we did internally. Simply just based on the expected refresh cycle that's going to have to occur over the next 5 years. With there's still a lot of legacy miners out there. Our research shows about 17% might be kind of that 35 and 38 and up type of rigs that obviously will either need to come off due to profitability or just simply end of useful life. And then somewhere north of 50% of the global hash rate are still some form of the older S19, S19J Pros, that generation. So those will probably have a little bit longer of a tail to them, but that there's definitely going to be a refresh coming, especially if hash rate stays as high as it is. I mean, I think efficiency is going to be a much bigger part of the game moving forward.
Hey, now you talk about demand for these machines. I know last time we talked, you guys were taking, I think, 99-cent pre-orders on the Seal Miner. one on your website. I think you said you had around 1 million. A two-parter for you, Jeff. When will people start to actually be able to receive those machines? And second parter, are you able to put a deposit down now on the SealMiner second version?
Yeah, so A1, we've decided to use that only internally. So we're going to do one run of it. That's happening right now. They're in manufacturing as we speak, and we did announce that we actually rolled a few hundred of them off to Rockdale and our Norway facilities for field testing. So we did announce that 3.4 exahash expansion plan that's going to happen throughout the next quarter into the fourth quarter. And that will be with SealMiner A1. So, SealMiner A1 is a good machine, but it's not, anything earth shattering. It was our first run at it. So, we like it. We were happy with it, but, we made some tweaks to it. And we're going to launch A2 here. As I said, we'll go into mass production in fourth quarter, assuming the chips come back the way we like. And that will be our first commercial rig that we'll launch. So we'll use that internally, but we'll also look to offer that and sell that to third parties. And then so right now I think I just checked our website. I think we've got about 1.3 million pre-orders. Again, 99-cent pre-orders. So but from talking to our sales guys, there's some meaningful size orders in there. So it's not just mom and pops in their garage that buying a couple of boxes. So, but we have A3 that's also in development right now. So A1 and A2 were both developed on the 4 nanometer platform. So, like I said, we were pretty happy with the efficiency and production we got on that 4 nanometer. A3 will step down to the 3 nanometer design. That's in the works right now, and that's incorporating our Bitdeer and some of the DesiWe miner specs into it. So that would be sometime 2025, Q1, Q2, I believe we'd look to tape that out. And then where it gets really interesting is SealMiner A4. So that's where we have a completely separate team working on the A4 design. And what's interesting about that design is that it's not necessarily the efficiency we're hoping to get there is not based on TSMC's processes. In other words, going down to the lowest and thinnest wafer. It actually is able to even step back on a couple processes to achieve that. So it's a completely new chip design architecture that Harris and his team are working on. So that's what we're most excited about.
Sounds like some really good updates. I mean, interestingly, you raise a good point, and people are always looking to see updates about increased hash rate, but actually, and you guys, your efficiency is probably one of the, I'm going to say, one of the highest in terms of you need more efficient miners in your fleet. I think last time I think it was 31.6. Yep. It was the fleet efficiency, and we're seeing now some of the miners now getting down to 22. So these new, even the first generation, the SealMiner, the A1s will benefit your fleet significantly, and that's important to know that these machines need replacing for every miner. It's not a case that we can just add to hash rate. You've got to replace machines because they just become inefficient over a period of time. They become old over a period of time as well. So it's good to know that you're focusing on replacing fleet, and at the same time, your designs then are bringing in significant efficiencies to then sort of like to boost the size of the fleet going forward. But that's a really good point. The next part is I mean, and this really is probably where you stand out more than literally all the other miners, is the fact that you've got a pipeline of power in excess of 2.5 gigawatts. So, we've just had Adam on the call, and they've got 1.2 gigawatts of power available at the moment in their pipeline. You've got over twice that amount. And if you think about power at the moment, power is the great commodity in the space, not just for Bitcoin mining, but for other business strategies as well. So Can you give us sort of like an understanding of and we know some of these, you've mentioned some of the projects that are in place at the moment, but sort of like give us a bit more colour to what's going on over the next sort of 18 months with regards to starting to utilise some of that significant pipeline you've got.
Yeah, so we have, like you said, we've got just under 900 megawatts of operating capacity right now, and another 1.6 in the development pipeline. That's power we've already secured. That's ours. That's in some form of either under construction or at least in the planning phases right now. So that was capped off by the 570 megawatts we just acquired in Clarington, Ohio, at the single site there. So yeah, we are building out right now. In progress are Tidal, Norway, Maslin, Ohio, and Bhutan. And we're starting the planning phases for the first phase of the Clarington, Ohio project right now. So yeah, we are also in the process of doing an evaluation of all of our sites. We brought in an experienced owners rep and project management group. This is a group that's built data centers for hyperscalers and other big banks and Fortune 100 type of companies. So we have them, as we speak, doing an evaluation of all of our various sites, really just to analyze them for suitability for HPC AI applications. So, obviously having just the power there is not enough. There's quite a few other intangibles that are going to be much different than what's needed for Bitcoin mining, which frankly isn't much. You basically just need power and a Starlink for connectivity there. So they're evaluating the access to fiber and just the general layouts of the sites, and just to give us kind of a roadmap, game playbook on where we should prioritize. So we definitely are moving down that path right now, and frankly, it's a bit of a natural progression for us given our expertise. We know infrastructure, we know data centers, and we know hosting. It's something we've done profitably and successfully for many years now, and we think a lot of that will translate over into the HPC side.
I'm assuming that the valuations on some of those sites would have, with regards to power being the sort of like the bottleneck now in North America for people using it for a whole multitude of industries. I would imagine some of those sites will be gaining in value on a day-to-day basis. Yeah.
I mean, I think there was a sort of a value set for in-place power and infrastructure kind of set by the miners over the last 18 months, somewhere in the $400,000 to $500,000 per megawatt range. We haven't seen a lot of new deals since then. I don't think we've seen, other than CoreWeave making that bid for Core Scientific. You can extrapolate what the price per megawatt they were willing to pay there was, but it's significantly higher. So I do think, while the market hasn't, we have not seen any real comps yet on that, I think it is fair to say that the value of power has gone up substantially, and I think that's going to be really reflected in the coming months for miners and being able to access new sites, especially large scale sites. I think that's going to be they're going to be few and far between moving forward.
Absolutely.
Hey, you talk about comps in the industry. Another comp we've been liking to ask everybody, your current energy cost per Bitcoin or your cash cost per Bitcoin, if you have that available.
Yeah, I'm running up kind of a new one right now, but the energy cost would be somewhere in the mid 30s right now. So I want to kind of run that against the rest of ours. That's against our existing fleet, obviously, which, as you mentioned, is not the most efficient. And I guess I'll touch on that as well. I mean, the efficiency, obviously, we skipped the last refresh cycle, for obvious reasons, because we knew we were going to be making our own miners, and we do absolutely intend to increase our efficiency with our own miners moving forward. After our the 3.4 exahash expansion, that should put our efficiency down somewhere in the mid to high 20s. We would model. So that'll obviously be a nice boost for us, and we can expect much more efficiency moving forward.
Yeah, no, I mean, and that's the thing. You've got the benefit of doing that with your in-house miners. Talking about, I mean, Bitcoin mining one side. Now let's sort of like look towards the HPC side, because at the moment, from what we're hearing for the last 3 or 4 months, the only conversation being talked about in the space at the moment is HPC. And ever since that deal was announced with CoreWeave back in June, I just imagine every mining company would want to have something similar on their books as well. You've certainly got the power in locations becoming available in the future. What are the sort of like conversations that you're having? I know you've got a HPC model set up in Singapore now, which is now starting to deliver revenues. But what's the plan for Bitdeer moving forward from now? And as that conversation's really relevant now until the Bitcoin price gets significantly higher, what's the sort of like strategy for Bitdeer moving forward over the next sort of 12 months?
Yeah, so we look at it in two ways. Obviously, there's two sort of models you can look at for HPC. There's what we call the full cloud service provider model, where you own the data center and the GPUs, and you're releasing those out to small middle market companies on either on demand or contractual basis. So that's we are doing that right now in Singapore. We've got a small facility there, about 250 GPUs, but they are, as we reported, 100% utilized right now. It's a combination of both. We've got some on-demand use, as well as some contracts, short to mid-term contracts as well. So we're seeing a lot of demand for it. So while there is a lot of demand for it, I think we've got a team working on this. They're a great team. They're looking to do a number of, not just offering the bare metal GPU time, but really looking to provide more of an ecosystem and some value added services beyond that. So to really make that revenue more sticky, because at the end of the day, I mean, that's a commodity, right? I mean, it's a GPU. If you're just leasing it out, there may be some location concerns there. Some people want their data domiciled in a certain region, and you might have an advantage there. But if it's just a commodity service, it's going to revert to the lowest price. So we want to put a bit of a moat around that and provide some value add there. So at the same time, we're cognizant of the CapEx intensity of that. I mean, the GPUs, you're looking at 10-12 million a megawatt for the data center itself, and then at least another 20 for the GPU. So that's not nothing. So if you're you get yourself on the wrong side of a refresh cycle there, or an upgrade cycle there, you could be in big trouble. So
with the transparency of the CoreWeave deal, I mean, Core Scientific aren't touching GPUs whatsoever. Yep. The energy cost is a pass through that. CoreWeave deal with the energy company directly. So really, it's more about providing facilities, to a certain level. We're not saying tier 3 level. They can't be tier 3 level at what they're spending on the refurb. Yeah. But, that must, with some of the sites that you've got and the size of your sites, that must be something you're thinking, actually, that is an opportunity, because it's not as capital intensive. Yes, there will be capital outlay, but maybe, you have a sort of like a hyperscaler that can actually fund some of the refurbishment and then have that as a payback in a similar way that they've outlined their strategy quite clearly for every other miner to see.
Yeah, no, actually, hats off to those guys. That's it's been a big help for sure. So no, that's where we see the real opportunity is in that US and European. Actually, we can touch on that too, but we think there's going to be significant demand for that in Europe as well, and we have our site in Norway that could be well suited for that. But that's exactly what we've hired this group to do is do the evaluation of just that. we see the real opportunity in that co-location opportunity market, and that's something we're certainly looking to move on once we have more information and the results from our study back.
In terms of Singapore site, which is, like you say, 250 GPUs there, I'm assuming you went for the 100s.
Yeah, those are H100s. Those are it's a top of the line facility. I mean, it's all actually
T3, yeah,
hardware, all NVIDIA, full NVIDIA software stack. So it's really state of the art, equipment. So, as I said, we will look to grow that, but cautiously, right? To make sure we're not over investing, in hardware that could become frankly obsolete before, or shortly after it's paid back. So, again, I think the biggest opportunity, and the one that's frankly most widely viewed by the market, is the co-location strategy, for no other reason than, one, those projects are very financeable, in a number of ways, but, at a minimum, at a project finance level, if you can get a hyperscaler or a tier one type of customer to lease that for 15 plus years, you can finance off that credit, and you can finance off balance sheet at very attractive rates. Done quite a few large project financings throughout my career, and banks love that. If they have that type of guaranteed cash flows on the backside, you can finance that at pretty low rates. So there's that, and the multiple expansion that can come with that. I mean, obviously, Bitcoin mining, most Bitcoin miners trade in the 6 to 10 times EBITDA range if you're lucky, but data centers routinely trade in the 15 to 20 times range. So even if it's 12 or 13 times, that's a huge, that's a big multiple expansion there.
Yep. I suppose it goes down to that predictability of everything that comes through into it. I mean, that's the game change. I mean, we can't even tell the price of Bitcoin tomorrow, but that CoreWeave contract, we can tell you every payment for the next 12 years. So it certainly appeals. But no, thanks for giving us an insight into that, and hopefully we'll get some more updates from that particular position as well.
Yeah, absolutely.
Hey, Jeff, we've got about 10 minutes left. I know we've covered a lot today, everything from the seal miner to self-mining to Bhutan to HPC. So I wanted to give you an opportunity, if there's anything we've missed, closing remarks, kind of upcoming catalysts, anything like that you'd like to touch on.
Yeah, I mean, geez, catalysts, there's a ton of them, I think. I mean, obviously, the seal miner is a big one. Look, frankly, we don't think that has been reflected in the stock price yet, and frankly, probably shouldn't be yet. I mean, that's definitely still a show me story. Market wants to see that we can execute on that, and I think that's fair. But obviously, we have the HPC opportunities as well. We have the power. I think institutional investors are taking notice of that, and they're the ones we've been talking to. There have been pretty extensive meetings, and as you said before, the vast majority of the conversations are around that and ASICs. A little bit, much less about just the actual mining itself. So that is going to be a big catalyst there. And again, just looking at our stock price, from a relative value standpoint, we still continue to believe that we're sort of under the radar and kind of underrepresented from a relative valuation standpoint compared to our peers. I think at level right now, I mean, I think we're just north of 2 times revenue, and trading well below on an EBITDA level. So again, relative to our peers. So we think there's the opportunity to expand on that, and once we start getting more execution, and yeah, I think those are the catalysts for sure.
I'm assuming when the seal miner comes online, we'll definitely be able to see it, because the name suggests we're not going to see much of it.
Yeah.
I'm wondering how many of those pre-orders are yours, Anthony, putting your name.
Yeah, exactly, man. You got a garage built out for this, or what?
Hey,
we couldn't afford it in the UK with the power. I'm afraid
those UK power prices,
No, not quite economical there. Hey, Jeff, it's always a pleasure. We love learning more about the business. I would tend to agree. Out of the miners, I think Bitdeer is definitely one of the lesser known. However, the amount of questions, comments, inquiries we're getting now about your company and your story has definitely picked up. So you guys are doing something right over there. We appreciate your time. Great numbers and results. Great discussion today. If you guys are still watching, make sure you hit the like button, subscribe to the channel. If you have any questions for the team at Bitdeer that we weren't able to get to today, feel free to drop them below. We'll add them to our list next time. Jeff, thanks so much again for your time. Anthony, if you have any closing thoughts, I'll throw it to you and we can wrap her up here.
Yeah, I mean, Jeff's absolutely right. You know, a lot of these miners are being priced purely on self-mining. We've had a similar conversation earlier today with another mining company, and we'll have another conversation later today with our third podcast of the day in a similar position as well, where, you know, the focus has been on self-mining, but the company's actually self-mining part of it is quite small compared to the rest of it. You certainly fit that criteria. You know, you've got your hosting business, you've got the HPC now online, you've got the seal miners coming in. These are big news items that just don't seem to be priced in. But I can understand on the seal miner, we want to see it in action. We want to see the results coming through. That first update, the efficiency that you're going to deliver on those machines, which will, you know, if you're changing from 31.5 down to 18. That's significant saving in energy cost. And if you said earlier on, you mentioned about the energy cost of being in the sort of like mid-30s. If you're producing in the mid-30s, that's pretty good, because TeraWulf, they put their July energy cost, which was the full energy cost on their update, and they're at 36,000, and they've got a sort of a blended fee of about 3.8 cents. So you must be doing something really well at Bitdeer with your efficiency to determine that sort of energy cost there. That's really good for retail investors to understand. But no, it's been a really good conversation today. Covered a lot of topics. So hopefully people can, you know, watch through the whole discussion and get a bit more of an overview of the company and put themselves in a better position going forward. Thank you.
And just to be clear, that those numbers were for the last quarter. I want to be clear right now. Obviously, the hash rate has gone up, so they would be closer into those 40s for sure. So for as we sit here today with where global hash rate's at. So just to be clear.
Understood.
Okay.
Understood. Still pretty good with that fleet efficiency, I'll say. But great discussion, Jeff. Thanks again. We'll see you guys here tomorrow and talk soon.